Your money is disappearing, but not how you think. Nobody's stealing it from your account. The balance stays the same. But every month, that money buys less stuff. A $20 bill today gets you what $19.50 got you last year. It sounds small, but multiply that across your entire savings, and you're looking at real money slipping away. Imagine walking into the grocery store and finding your usual cart now costs an extra $20. That's real money slipping away. Here's how to stop the bleeding. Let's break down exactly how this happens and what banks won't tell you. Your bank statement shows $10,000, but here's what they're not telling you about what that money is actually worth. The number looks the same every month, maybe even grows a tiny bit. But behind the scenes, something else is happening. Your money is slowly losing its power to buy stuff. Let's break down the real numbers. According to national FDIC data, the average savings annual percentage yield is just 0.41%. That means your $10,000 earns about $41 over 12 months. Sounds better than nothing, right? Here's the problem. Inflation has been running between 2.4% and 3.5% since June 2023. That means everything costs 2.4% to 3.5% more than it did a year ago. Here's what that really means. Your money earns 0.41%, but prices go up by 2.4 to 3.5%. You're guaranteed to lose 2 to 3% of your purchasing power every single year. It's not a maybe, it's basic math. Think of it like this. You have $10,000 sitting in your savings account. After 1 year, you have $10,041 thanks to that tiny bit of interest, but everything costs 3% more now. Your $10,041 buys about what $9,741 bought last year. You lost nearly $300 in buying power, even though your account balance went up. Let's make this more real. Your weekly $50 grocery run becomes $51.50 with 3% inflation. That extra $1.50 doesn't sound like much, but over a year, you're paying an extra $78 just for the same groceries. No wonder 65% of Americans say their money doesn't keep up with rising costs. They're right. The math proves it. When your savings earn 0.41%, but everything costs 2.4 to 3.5% more, you fall behind every month. This isn't bad luck. It's not temporary either. It's how the system works. Banks pay you almost nothing while prices keep climbing. They make money by lending your deposits to other people at much higher rates. You get the leftovers. But here's the real shocker over a decade. Let's say you keep that $10,000 in your savings account for 10 years. With 0.41% interest, you'll have about $10,420. Sounds like free money, right? Wrong. If inflation averages 2.5% over those 10 years, your $10,420 buys what $8,100 bought when you started. You lost nearly $2,000 in purchasing power. The banks don't advertise this math. They focus on the small interest payments and the safety of your deposits. Both are true, but they're only part of the story. The missing piece is what your money can actually buy over time. Every year you keep significant money in regular savings accounts, you lose 2 to 3% of your purchasing power. That's $200 to $300 per year on every $10,000. If you have $50,000 saved, you're losing $1,000 to $1,500 annually. The numbers get bigger as your savings grow. You might think this is just the cost of keeping your money safe. But safety is an illusion when your money loses value every year. You're guaranteed to have less buying power in the future, not more. So far, this looks grim, but you can fight back. Next, I'll show you simple steps that actually work. Financial experts have a harsh name for traditional savings accounts, and once you hear it, you'll never think the same way. They call them a guaranteed way to lose money. Not because the bank takes your cash, but because your money loses buying power every single year. Think of it like this. You're on a treadmill that's moving backward at 3 miles per hour. If you walk forward at 1 mile per hour, you're still moving backward overall. That's what happens with regular savings accounts. The interest moves you forward slightly, but inflation moves you backward much faster. Here's what that really means. Financial advisors see traditional savings accounts as wealth destroyers, not wealth builders. They understand something most people miss. When your money sits still while everything costs more, you're mathematically guaranteed to fall behind. Every year, without exception. The safety of savings accounts becomes an illusion when you factor in what your money can actually buy over time. Sure, your account balance stays stable or grows a tiny bit, but that stability is fake if everything costs more when you want to spend it. No shame if you didn't know this. Banks don't exactly advertise the inflation problem, but once you understand it, you can do something about it. Let's start with the simplest upgrade. Right now, High-yield online accounts are averaging around 4% annual percentage yield, up to 10 times more than the national average. With inflation at 2.4% to 3.5%, these accounts actually beat inflation by 1 to 2 percentage points. Your money grows in real buying power, not just on paper. Here's the simple version. If inflation is 3% and your high-yield account pays 4.5%, you gain 1.5% in purchasing power every year. Your $10,000 doesn't just keep up with rising prices. It gets ahead of them. Money market accounts work similarly. They often pay rates close to high-yield savings accounts. Some require higher minimum balances, but they give you check writing privileges and ATM access. It's like a regular checking account that actually pays you decent interest. Certificates of deposit lock in those 4 to 5% rates for terms of 6 months to 5 years, guaranteeing you beat inflation if you don't need immediate access. But here's where it gets interesting. If you want to move beyond just beating inflation over decades, broad index funds have averaged 7 to 10% annual returns, well above typical inflation rates. You don't need to be a stock expert. Tools exist that let you own a slice of the entire market with a few taps. Index funds are basically baskets that hold hundreds or thousands of stocks. When the overall stock market goes up, your index fund goes up. When companies across America make money, you make money too. The key is understanding that index funds work over years, not months. Some years they go down, but over long periods, they've consistently outpaced inflation by a wide margin. We're talking about 4 to 7 percentage points above inflation on average. If the idea of investing feels scary, start with high-yield savings accounts. They bridge the gap between traditional savings and investing. You get inflation-beating returns without stock market ups and downs. Once you're comfortable with that, you can explore index funds for money you won't need for several years. Here's what makes this accessible. You don't need thousands of dollars to start. Many high-yield accounts have no minimum balance. Some index funds let you start with $100 or less. It's not about big numbers. It's about getting your money working harder than it is right now. The tools exist to fight inflation. High-yield accounts for money you might need soon. Index funds for money you can leave alone for years. Both beat the guaranteed wealth destruction of traditional savings accounts. This is why financial experts call regular savings accounts a guaranteed way to lose money. They force you to accept inflation losses when better options exist. So if you're tired of guaranteed losses, here's exactly what to do right now. Your money is either growing or dying. There's no neutral ground when inflation is in play. Every dollar sitting in a regular savings account loses buying power each year. That's not an opinion, it's math. Here's your first step. Open a high-yield savings account this week. Don't wait. Opening a high-yield account takes minutes, and you start beating inflation day one. Many online banks offer them with no minimum balance. Your money will start beating inflation immediately instead of falling behind. Once you're comfortable with that, explore simple index funds. Start small if you need to. It's not about big numbers. You now know what most people never learn. Your money should work as hard as you do. Take back control starting today. Hit like if you've ever felt squeezed by rising costs, and subscribe for more no-nonsense finance tips.